Alphabet Google has more than doubled in value over the past year. That much is settled. What is not settled is whether that doubling is the beginning of something larger or the last exit ramp before a crowded trade unwinds. And two institutions with combined assets exceeding $500 billion gave opposite answers on the same stock last quarter. Bill Ackman's Pershing Square slashed its Google position last quarter, redirected roughly $2 billion into Microsoft, MSFT. Berkshire Hathaway, led by new CEO Greg Abel, simultaneously tripled its Alphabet stake before shares accelerated further. Both moves were executed at nearly identical price levels. Both funds have long track records. Both declared they were making high-conviction calls. Pershing Square said the Alphabet sale was not a bet against the company, it was capital rotation driven by conviction in MSFT. Berkshire said nothing at all, which historically is more telling than any statement. The Musk OpenAI trial delivered its verdict today. A federal jury dismissed all claims in under 2 hours on statute of limitations grounds, handing a legal win to OpenAI and Sam Altman. Microsoft, which holds a roughly 49% stake in OpenAI, edged higher on the news. That same capital Ackman moved from Alphabet into Microsoft now sits adjacent to the legal entity that just defeated Musk, and Berkshire's tripled Google position sits on the opposite side of the AI legal battle's beneficiary. The NextEra Dominion deal, valued at $66.8 billion and announced Sunday, was the session's dominant structural story. The combined entity will carry a 130-gigawatt construction backlog, enough to power 100 million homes, making it the world's largest utility, precisely as AI data centers are projected to strain the national grid. NEE and D surged. The AI power trade, which had migrated into software and chips throughout the spring, reasserted itself through infrastructure today. Quantum names sold off across the board. IonQ down 7%, QBTS down 8%, RGTI and QBT each losing 9%, despite all four having reported strong earnings over the past 2 weeks. No company-specific news drove the move. RSI readings peaked and rolled. The sector's own momentum became the catalyst for its decline. Meanwhile, NVDA added 1.33% ahead of fiscal Q1 results due Wednesday after the close, with Morgan Stanley raising its price target to $285.
The surface reading is that two managers with different time horizons simply disagree on valuation. The surface reading is incomplete. Ackman sold into strength. Google had already doubled and deployed into MSFT at a price where Pershing Square's models showed superior risk-adjusted return. That is orthodox portfolio management. What makes this session's data point unusual is that Berkshire made the opposite move at the same entry window, and Berkshire's new CEO Greg Abel does not have a history of momentum chasing. Abel's public commentary has centered on Alphabet's AI positioning against Amazon, specifically the view, cited by the Motley Fool, that Google's search and cloud integration gives it structural advantages Amazon's retail-first architecture cannot easily replicate. That framing matters because it locates the Berkshire thesis in competitive moat, not price momentum. Ackman's thesis, by contrast, is explicitly a capital allocation decision. MSFT's OpenAI stake, its enterprise software dominance, and its 49% position in the entity that just won its legal battle against Musk represent a cleaner compounding vehicle in Ackman's model. The gap between the two positions is therefore not a disagreement about Google's quality. It is a disagreement about which AI beneficiary captures more of the next capital cycle, the established search and cloud integrator, or the platform that owns the largest third-party stake in the model infrastructure layer. A counterexample exists. In 2012, hedge funds exited Apple after its 700% run, while Berkshire eventually entered near the top of that correction. Apple proceeded to deliver another 1,200% over the following decade. The parallel is imperfect. Google has regulatory exposure Apple did not, but the directional question is identical. Does institutional selling at record highs signal exhaustion or simply rotation? What that historical case does not settle is the regulatory variable. The Department of Justice antitrust case against Google Search remains an active overhang. If the DOJ mandates structural remedies, forced divestiture of Chrome, restrictions on default search agreements, Google's moat argument weakens independent of earnings quality. Ackman's rotation into MSFT implicitly prices in that risk. Berkshire's tripling of Google implies Abel either discounts the regulatory risk or believes the moat survives it.
The unresolved question from the institutional divergence is not which fund is right about Google's quality. Both likely agree the business is excellent. The question is whether the DOJ outcome or NVIDIA's Wednesday earnings report changes the capital flow calculus before either position needs to be reevaluated. NVDA's Q1 fiscal 2027 report, due Wednesday after the close, is the most direct test of whether the AI infrastructure spend cycle is accelerating or plateauing. Morgan Stanley's $285 price target implies continued upside. If NVIDIA guides flat or below consensus for Q2, the AI capital cycle thesis that underpins both Google's cloud growth and MSFT's Azure expansion faces a simultaneous test. A strong NVIDIA print extending the AI infrastructure thesis strengthens the Berkshire Google bull case: more cloud demand, more search monetization via AI overviews. A weak NVIDIA print or cautious guidance would push capital towards the safe compounding vehicle, which Ackman has already argued is MSFT. The SpaceX IPO, targeting a $1.75 trillion valuation in June, adds a complicating variable. Historical analysis of mega-cap IPOs, Alibaba in 2014, Meta in 2012, Uber in 2019, shows consistent underperformance in the 1 to 3 year window following listing. If SPCX enters indexes at that valuation and immediately draws passive inflows, it competes for the same growth allocation dollars currently split between NVDA, Google, and MSFT. Atkins' rotation may already anticipate that crowding. The lean here is that Berkshire's bet survives if NVDA guides above consensus Wednesday. That confirmation would validate the AI infrastructure cycle and lift the cloud compounders, including Google. The lean shifts toward Ackman's MSFT thesis if NVDA disappoints, regulatory pressure on Google search intensifies, or SpaceX's June IPO absorbs the growth dollar rotation that would otherwise flow to megacap tech. Watch Google's 175 level as the near-term support that Berkshire's accumulated cost basis simplifies and defends. If that level breaks on post-NVIDIA selling, the institutional divergence resolves in Ackman's direction faster than either fund expected, and the question becomes not which manager was right, but whether both entered a cycle that is already later than the price suggests. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.